Well, good afternoon, everybody, and welcome to our mid-December edition of Bull Sessions, our December 14th edition. My name is Mark Robertson. I am joined here by Ken Kabula. Good afternoon, Ken.
Good afternoon, Mark. Good afternoon, everybody. Glad to see we have an audience this close to Christmas, and we actually have a pretty decent audience. So thanks for coming out this afternoon. We appreciate it.
Yeah, we're winding down a pretty decent year again, and it's just been one of those weird years again when it just doesn't feel as good as it ought to. And I think we covered that pretty well last week with how much the top 5 stocks have contributed versus the massive number of stocks that have not done well. But we've successfully avoided most of them. So we should embrace the Christmas miracles as they happen. Good stuff. All right, so I'm going to cover Marty Feldman. That's a name kind of snuck up on us. Marty Feldman Vision here in today's session. A little bit about the Epiphany Countdown and just basically make some quick stops along the way. But let's go ahead and get underway. A lot of very regular, wonderful attendees. Big hug to all of you. If you're new here, welcome. We do try to keep this fairly informal. Ken will be watching the questions tab, and if you do have audio equipment, we can open up for a microphone. We try to keep it informal, and we want to cover a few main points, but we are here just to share ideas and have some fun. All the stuff that you see here is about education. It's to illustrate and demonstrate the techniques, methods, and philosophies of the modern investment club movement. You'll hear opinions. They are opinions, whether they're shared by those of us at Manifest Investing or just championing the legacy of wonderful lessons learned by the National Association of Investors and Better Investing. But please understand that they are opinions. Please do your own homework. If we mention a stock, please do your own homework. Make your own decision. If we own a stock, we'll try to remember to mention that. You may assume that we own the best small companies, because we do. And if you would like to be invited to or have a reminder to our monthly webcast known as the Roundtable, the next Roundtable will actually be in the December Roundtable will actually be in the first week of January, just after the new year. Please send an email to nkabula1@comcast.net and you'll get a reminder. And if you have any follow-up to this session, whether it's questions or requests for slides, or suggestions for future topics, our 2 email addresses are listed there on the slide. And we'll probably have the objective of fielding some end-of-year questions next week, Ken, so maybe we solicit that at this time.
Sounds good.
All right, here's kind of our standing agenda. We're going to cover Marty Feldman, going to talk a little bit about kidding around. And I actually, in order to buy myself some time, I'm finding that I need to buy myself some time here lately. Epiphany versus Christmas. So sometime over the next approximately 20 days, we'll issue 12 stock selections. And then kind of our standing features to talk about these long-term S-curves. We're calling them S-curve perspectives. And we're going to touch on Sherwin-Williams a tiny bit here today. And then, of course, our traditional Groundhog update. And then, as always, our best small companies. We will tackle those other subjects at the bottom of the page soon. And I would say really soon, like early January at the latest. Early to mid-January. Any other comments or questions, Ken?
No, it's a good agenda, and we have a lot to cover in a short amount of time. So here we go.
All right.
You thought you were having a rough day, huh?
This reminds me, it's on a much different scale, but I can remember I used to have a bunch of really cool baseball cards, and I actually had stored them in my old microscope kit. Remember the science kits you used to get the kids when they were young, Ken? You kind of like a tin box or a steel box. I had all these cards in there: Stan Musial, Bob Gibson, Ernie Banks. And my mom actually sent them to the local dump while I was in college by mistake. She didn't do it on purpose. And it didn't have quite this amount of money. But here's a guy who tossed away a hard drive that had $500 million on it in Bitcoin. and he's trying to get permission to excavate the dump now. It's quite an interesting story. If you Google it, you can read it. But wow, I mean, I'm Ken. I just got to say, I'm happy that none of our brokerage portfolios have this problem. I mean, I forget a password every once in a while, and I figure out how to get back in. But
I wouldn't know what to do with $500 million anyway, Mark. So.
Well, if you stumble onto $500 million and you're not interested in it, I'll help you.
All right.
All right.
If
So
I
that is a rough
stumble on
day.
it, I agree to split it with you, Mark. I'm saying it in front of witnesses, even. Okay, here we go.
Well, I'll take it. I've already got Sean Mace splitting a share of GameStop with me if it goes
All
to
right.
$100,000 a share. All right. Here's our best small company update for this week. We have actually lapsed and gone. We're back to where we're trailing a little bit. Just to recap, this is the value of $2,000 invested on Halloween. Traditional is the old buy and forget from Halloween to Halloween. All original 20 stocks being held. The middle bar is basically the impact or the effect of us selling one position that was eHealth when it dropped so dramatically, and perhaps a change in fundamental conditions, and replaced it with Pacira Biosciences there in the middle of the chart. And Pacira has been outperforming eHealth since that day. Keep in mind that the eHealth would still be active in that red bar, so it's kind of a contest of one versus the other, and then the total market is on the far right. So from top to bottom, kind of that same distribution we see every year. It's truly the rule of five living out, and taking shape before our very eyes. And any surprises here, Ken? Anything that grabs you?
Well, I'm really pleasantly surprised that Sam Adams Boston Beer has moved way up that scale. I expected it to move, but I did not expect it to move that dramatically, that quickly. It sat down on the bottom of our list for a long, long time last year, and then we put it on the list again, and there it is sitting up in what's that, fourth place right now? Pretty decent.
Yeah, it's gone from 450-ish up to 525 in pretty short order. So maybe that is suggesting that the millennials or whoever it was letting us down on the flavored seltzers. Maybe they're back at it at Christmas parties.
Or maybe they've gone on to something besides seltzer. Now, the millennials that I'm in tune with, which happen to be my grandchildren, are really heavy into liquor that doesn't taste anything like liquor. So,
I know how that goes too.
yeah.
All right, so probably the one most disappointed me at this point is Sharp's compliance. I understand the economic slowdowns and stuff, but I still have a lot of faith in that one. I share your admiration for Boston Beer. I'll cover iRobot in a second, but did you have any thoughts on Superior Group being down in kind of that tenuous land of we definitely put them under the microscope when they dropped down into the timeout range?
Superior Group sits in not only in our small companies, but sits in a couple of portfolios that I have a stake in. So I kind of watch it a little bit more carefully than some of the stocks on this list. And Superior Group, I think, is a victim of, golly, I don't want to be insulting to people, but the laziness of the typical investor, I think, results in a lot of market moves and gives investors that take just a little bit more time with their investment, it gives us opportunity. I think that a lot of times a stock missing earnings, going down in revenue or going down in earnings, I think it's a knee jerk to sell the darn thing. And you can push that out for a couple of weeks sometimes if you get enough momentum behind it. Superior is the victim of its own success last year. And if you listen carefully to the earnings call, or if you even read the press releases that come with the last couple of quarters earnings, you notice that it's not an instance, it's not a case of Superior Group doing poorly this year. It's 2021 quarter compared to 2019 is up significantly, but it's a case of comparing it to last year's quarter, which was artificially inflated. I know you don't say that too often with a COVID going on, but the COVID quarters for Superior Group were inflated by the huge orders that this company received to create and sell PPE, personal protective equipment. And you can think back a year, year and a quarter, year and a half. You can think back to where hospital gowns and all kinds of masks and the caps that they wear in settings in the healthcare industry, where all that kind of PPE was in short supply, and where hospitals were complaining, where doctors are complaining they had to wear something that was supposed to be worn once and then discarded. They were wearing it for, in some cases, for a full day. So Superior Group and a lot of other people in the country stepped into the void, and they don't normally make PPE, but in this case, they set themselves to making PPE and sold an awful lot of it to whoever was ready to buy it, which was a pretty big set of customers. Well, those customers now have gone away. It was never anticipated that PPE was going to be a permanent part of Superior's product line. And so they've gone back to their traditional product line right now, which is extensive. And like I said, their revenues and their earnings are better than trend if you take out the COVID year of 2020 and go from 17, 18, 19 up to 21, you'll see that the trend is actually increasing. So all in all, this downward right here, for my purposes, this is a buying opportunity for this company. Other than the loss of PPE business, I can't see any reason at all that Superior is having issues. All the other parts of their business increased nicely, but without the PPE business, the comparison between 2021 and 2020 doesn't look real good on a piece of paper.
That's fair enough. And Ken, I think you shouldn't hesitate to shame people for being lazy when it comes to investing. That's okay. Lazy shaming. And the other thing that kind of comes to mind is, we did that presentation on Across the Chasm when this all started. And I'm thinking maybe we need something that involves ripple effect or
the cliff
or something. Yeah. The opposite of chasm.
Yeah,
caused by a temporary disruption. And I think iRobot's in one of those too. And that's the one that I want to talk about just for a minute. Here's the slide from Halloween where we took a look at iRobot, and we did admit that it could have been a little bit frothy. It was already down from approximately $95 down to the low 80s. It's now dropped into the mid 60s. And all of the stuff which you can imagine that has to do with the COVID-19 pandemic and semiconductor stuff and supply chain and all that, it's affecting them without question and causing some disruptions, including tariffs. And so the question that we always ask is this something that's going to kill them? Is it terminal or is it temporary? I think it's temporary. I really do. And I think, in fact, we are the brand new owners of one of those little devices that runs around on the main floor of our house now. And I don't watch TV anymore. I just sit and watch that, run around in the living room. No, but I think it's temporary. And I think that inflection down in profitability that you see in 2021, is that long-term trend possibly impacted in some way with the type of market share that they have? There's a whole lot of trading up going on. I think the story's intact, and we'll watch it carefully, but right now we're basically looking at mid-teens for return forecasts, and it's operating near lows. So again, we'll keep an eye on it, and keep it on a short leash. But I think it's being January affected pretty substantially, and we'll see how it goes here in the first quarter.
Yeah, I'm just going to answer a commonly asked question, Mark. Folks, when you see an asterisk next to a company in manifest investing, it just indicates that that company is not part of the value line 1700, not part of the main value line. It's either in the small and mid cap edition or it's not in value line at all if it carries an asterisk. That's the only reason that it's there. It has nothing to do with anything else other than being included in the main value line or not being included in the main value line.
All right. Here's our current Groundhog Results. Nick's in the audience. He's clinging with the white knuckles to that 0.1% lead. Ruth and Barb from Indianapolis are right on his heels. And pretty good showing by the group. It's better than it was. And Ken, I kind of am fascinated by the number of bolded group entries that seem to be bubbling back up the list.
Yes, Space Coast has moved up to into the top 10 now, and Mid Michigan's almost there. So that's a really nice race going on between 4 clubs there for the top spot: Space Coast, Mid Michigan, Bauer City, and B.I. Baker. Really nice, really nice.
Bauer City is making a pretty good run at taking over the all-time lead on our Hall of Fame chart. So hat tip to the ladies over there in Janesville, Wisconsin. Kathy Wood continues to struggle, and we hope to finish out well here over the next 6 weeks. It's actually one of our weaker performances in several years collectively, but pretty strong performances on this chart. I keep looking and squinting really hard to see my name at the bottom of this list, and it's just not materializing down there, Ken.
Not there yet, huh? Okay. We should give a nod to the cool kids, Mark, that have moved ahead of the Wilshire 5000 now.
I did see that.
Those are the grandkids, not my grandkids, but those are Herb Lemkohl's grandkids up from Traverse City area. So it's awfully nice to see one of those Traverse City clubs up above the Wilshire too.
Mm-hmm. And Herb's right behind him, so he's lurking. All right, let's talk about an article here that came out fairly recently. It was forwarded to us by Bob Shaw, and basically with the question, why haven't we talked about this guy? And I think we may have talked about him briefly years ago on iClub List, but it's kind of the answer to the question. Comparing oneself to Berkshire Hathaway here recently, and recently being over the last 10 years, it's kind of a low bar, and I don't mean that disrespectfully. But Berkshire Hathaway has had fairly modest performance here over the last 10 years, actually checking in at 1.7 percentage points behind the market. And this particular gentleman, Wilmot Kidd, he runs a closed-end fund called Central Securities. When you look it up under closed-end funds at Morningstar, for example, under the ticker symbol CET, you can actually get a look at his portfolio. And he's been doing this for over 5 decades. So he's got quite a track record established, and it actually is quite good, but it's not off the charts good. A number of people here today have comparable performance over perhaps not quite as long time frame, but we can look back at the 8 decades with the modern investment club movement and find a number of people who have similar performance. So, including the Mutual Club. The Mutual Club would have been in that same level of performance. And Ken, you had mentioned that you thought you saw this article in the past?
If not this particular article, Mark, something very similar to it. I've read about this gentleman at least once before, but it had to be at least 5, and I'm thinking maybe 10 or 12 years ago.
Yeah, I know he's appeared a couple of times in that type of a spirit. This is the same article that was published in the Wall Street Journal last week, only this is from 25 years ago. And it's a decent article. I love the fact that he underscores Phil Fisher and identifies some from stuff on here. Didn't care so much for the comment at the end about luck. I think that's just a kind of a cop-out. But Phil Fisher's Common Stocks and Uncommon Profits is an absolute classic. And just some nice stuff here. So again, that's from 25 years ago. And here's a look at that performance. Again, hasn't done that well over the last 10 years. The magenta or maroon is the Central Securities portfolio, but you start going back into these type of time frames, and these are pretty strong. 12 to 14%. Again, I actually sat in a chair and watched the mutual club achieve those type of levels or more. So it's not like it's unprecedented performance. And you start talking 30, 40, 50 years, he wouldn't even come close to keeping up with Buffett on this chart. So good stuff. And then we take it a step further and take a look at what's in the portfolio. Is there anything in here that would be attractive to us or perhaps new to us? And I think we know most of those tickers. I'm not familiar with CCOI. I just noticed that when we were talking about this a few minutes ago, Ken. Not sure what company CCOI is down here, but I think we know the rest, and many of the big five are in here too. So any thoughts on the portfolio in general?
Well, 20, almost a quarter of the portfolio in a single private held holding that I don't know anything about, and that because it's privately held, most folks don't know anything about. That kind of skews the results and makes it very difficult for anybody else to do the same kind of thing or to mirror this portfolio. Also, the fact that he hasn't been unaware of the large growth stocks in the last 10, 15 years. I mean, you look down that list, you see Google, you see Facebook, you see Microsoft, you see Amazon. I thought I saw one other one on there too.
Yeah, Google at the top if you didn't mention that.
Alf, I did, but it's a good, solid portfolio, and Amazon is the one that I missed, right smack dab in the middle there, and it's the kind of portfolio that I probably own a third or maybe even half of the stocks that are on that list in one portfolio or another. And I'm sure that you own a significant piece of that too, because we're looking for the same thing, quality growth.
Yep. So no big surprises here. You can actually find information on Plymouth Rock. Wilmot is actually on the board of directors of Plymouth Rock, so he's got pretty up close and personal information on the company. But I just find it kind of interesting. Reminds me of American Heritage Fund and Heiko Taimi. Many years ago, he was a superstar on Wall Street, and he had a bunch of private stuff in the portfolio that didn't fare so well. When the tide went out, we found out who was swimming naked. Let's put it that way. All right. Well, here's our fairly regular feature now of just pointing out that S-curves are real, and we still recommend that presentation be checked out by people. You can Google it and find it, and just the point that you want to be aware of, whether the stock you're dealing with is core or non-core, and where it might be in its life cycle.
Yeah, Mark, can you stay on the graphic for just one moment? I had an online discussion with one of our regulars here, and he was making a point that companies didn't always stick to a year in each one of those things. And I guess I made the counterpoint that I don't think those numbers up at the top were ever meant to signify 1 year at this, and then the second year at this, and the third year at this.
Oh, gosh.
I just think that they're there. They're just to give you a list 1, 2, 3, 4, 5. They're not talking about actual time periods, and some of these time periods, Mark's drawn them as roughly equal. But company to company, I think the length of these different categories can stretch or shrink depending on what the company does and how it reinvents itself and what its product happens to be. There's a lot of different things. A biotech, for example, might have an R&D and a launch sequence that is equal to 3/4 or 80% of its entire picture at the moment. And it might, it might not have even begun to go into decline yet. But those are not years, and the equality of the of the columns is not meant to indicate that each of these happens in approximately equal time.
Yeah, and if you looked at a company like Hershey's, that number 4, well, the end of 3 and 4 would be quite wide. Maturity can last for a long time in a company like that.
Yeah, and it's possible for, I think at least it's possible for a really high quality company with really good management to kind of go into a second series of S curves if they duplicate things correctly. I think that we've seen that happen with Apple. I think we've seen it. I think to a certain extent we saw it happening with Microsoft, Mark.
Oh, absolutely. Then we'll take a look at a quick look at that in a minute. And Intel, obviously, Intel reinvented itself several times over. So yeah, these are not meant to be any. These are all variable durations or periods on this chart. But the point that we are trying to make with this series of case studies that we do is that it's not just theory. It's reality. We're going to talk about Johnson & Johnson here in a minute and talk about this notion of, as I'm now currently defining it, and you'll see why here over the next few weeks, projected operating income divided by enterprise value as defined as by what you see there. And the talking points that we've covered in the past are right there. We're going to go through those in a minute. But, here's an example. Here's Under Armour. You can see a couple phases there. They are probably into one of those middle phases now. And they would probably have to find some mode of reinvention to start a new growth trajectory, probably would be my guess. Perhaps different leadership. They did go through some accounting challenges that people have pointed out. But the reason we like the chart is it clearly shows there's a couple different phases that are just like on the previous chart. All right, and here's one of Ken's favorites. I think he gets Christmas cards from the team at Microsoft every year for all the shares that he owns. But a little longer look going back to 1988, and you can definitely see different growth phases here. And perhaps a little bit of that reinvention on the right-hand side there. And just kind of one of our favorite charts to look at and comprehend.
Well,
Go ahead.
And those of you that are old enough to remember the entry into the consciousness of the general population of computers, you can remind yourself that Microsoft was a single product company for quite a few years at the beginning of its history. It relied on DOS, the disk operating system for the PC, and that was the product. That was what it had, and that's what provided the basis for the whole company. Some of you might have had parents that questioned what you would ever want to use a computer for. I can remember standing at a faculty meeting as a new principal and suggesting that we were going to latch on to 5 email accounts that our countywide school district was going to provide each of the districts within their boundaries for them to use for whatever they wanted to use them for. And I couldn't give those things away. I couldn't give an email account away. Nobody could ever understand why you might want to use email or anything like that. And of course, this way precedes the era of texting or anything along those lines. So Microsoft has certainly gone through a lot of changes and a lot of iterations. At one point, they tried to make themselves into a gaming company. Succeeded pretty well with the platform, maybe not quite so much with the games that go on the platform. They had to resort to finding other people to do that for them. But this is a company that right now is under superb management. And I just dread the day that they're going to have to announce that Satya Nadella is going to move on, and they're going to look for a new manager to run the ship, because finding people of the highest quality is what's going to be the key, I think, to keeping Microsoft relevant as we go into the future.
I'm just, you talk about this time of year being thankful. I'm just grateful for the people that we know. We actually know people who were involved in the key projects at Microsoft in the 1990s, from the development of Excel to Office to, I mean, and they actually have been a part of this community for a number of years, and they were on that rapidly sloped green line on the left-hand side here. And many of them retired early, as I understand it, Ken.
Early is an understatement, Mark.
Yeah, good stuff.
Yeah.
All right, story for another day. The day that I used Lotus Note or a Lotus 1-2-3 presentation while on the stage in Seattle. Remind me. All right, today I want to.
I have a relative still using Lotus 1-2-3, Mark. So I'm going to one up you in that instance. Okay.
I might have to try to dig it up just so I can have it when I go out there the next time. But what I thought we might spend a few minutes talking about, this is a company that is fairly close to us. I mean, I can remember years and years ago I recommended it as a stock to study at Better Investing Magazine. And Sherwin-Williams, the paint people. And the thing that I find fascinating, and I just want to make the point and the reminder that when you're out there digging up information on a company and going through your calculations or whatever, just be aware that sometimes those opinions can be quite different, and you have to reconcile those differences or whatever. The thing that I have trouble reconciling for this company is the flatness of that fair value estimate. As you'll see here in a second, the company is clearly firing on all cylinders, and I have been unable to understand this for a long time, this flatness of the fair value. I mean, this company's over $300 now with a fair value, almost $350, of a fair value of $137. And, suggesting that it's extremely overvalued. And it just doesn't add up that way for me. So this is just an example of a company that doesn't seem to add up very well. Here's a look at the company using a little bit longer term look at the company going back to 1988. And I do think this is an example of a company that perhaps has reinvented itself a little bit, Ken.
I know quite a bit about Sherwin-Williams, Mark. I had an uncle that was the chief auditor for about 25 years. This is a Cleveland-based company. Cleveland's where I grew up, my hometown. And this company is no longer a medium-sized regional paint dealer. This is a worldwide dealer of paints and coatings and anything liquid that you can slap on anything that's not liquid. You're going to be surprised, I think, if you dig into this company to find out how many brands that you think are independent are really just another branded paint under the Sherwin-Williams umbrella. You need to take a real deep look at all the different ways that Sherwin-Williams sells paint to the consumer. It's not just those little stores that sit in strip malls all over in small towns across America. It's paint coming from all the big box retailers and paint being sold in all kinds of other locations besides the branded Sherwin-Williams stores. It's quite a story, and you can see that profit line. I don't see that happening too often for a mature company, but look at 2010 on the top, the pink line. Look at 2010 up until about 2018, and look at the steepness of that line compared to the revenue line. Usually these two match, and that's what's happening from maybe 2017, 18 onward and into the future. But this company did something right there to increase profit margins. And in the process, I think they increased their value. I don't know. I agree with you. I don't know where Morningstar's model is coming from. It appears to me that their model is out of sync with what's actually happening right now.
Yeah, I look at the company and maybe they just don't believe the profitability on the right-hand side, but there's quite a bit of evidence there now. I understand what happened in 2008, 2009, and in fact, this is just another item in the arsenal of reasons for the housing stuff that we talk about all the time. Because over the long term, this is going to be a fairly constant or steady growth situation, of painting things. And they obviously had a few years off in the right around 2008, 2009, and the few years that followed. But I mean, Value Line also has some fairly constricted opinions. So again, just a reminder to be careful out there. We look at the company and see projected return on value or projected annualized returns in that 4 to 6 range. That's not exactly the end of the world, and it's nowhere near this characterization down here. So just food for thought, and just a reminder to be careful out there.
Yeah, this company's been quite successful, Mark, in grabbing up other paint brands, other either whole companies or parts of companies that that wanted to be acquired, and they've not been afraid to look at companies that had margins significantly less than their own margins, and then make public statements about in the next X years we're going to make their margins match our margins. We're not going to allow our margins to deteriorate. Rather, we're going to raise the margins of this new guy that we brought into the fold, and we're going to make them contribute to our margins, which we are very proud of, and we want to see keep moving in the right direction.
Well, everything seems to be in the right direction there. It's pretty hard to argue with the PE in anywhere in the 20 to 25 range for sure. And obviously that bottom line trend of earnings is pretty strong also. So they are, for whatever reason, they're executing on a strategy, no doubt about it. All right. So with that, let's go ahead. We've got a few minutes left here. Let's talk about investing as inspired by Marty Feldman. Not a name that we kick around very often, huh? But
Marty is not a Wall Street analyst for some of you younger folks in the room, okay?
But obviously he's chosen because he's got a particularly strength of vision and seeing things from different perspectives at the same time. So let's go ahead and talk about a venerable company and walking through some of the aspects of doing these type of calculations. What I want to do is take us through a quick return forecast using a preferred procedure. And the company is Johnson & Johnson. You guys all know this one. In fact, I'm wearing a Johnson & Johnson Band-Aid on my left hand after tennis last night. So you know the products, the pharmaceuticals and the devices and the consumer goods that this company represents. And what you're looking at here is just an attempt to characterize the top line. Fairly steady top line, a little bit of a dip there with the 2020 challenges that were faced. I was a little bit surprised, Ken, to find out that their COVID vaccine is less than 0.5% of their total business.
That doesn't surprise me at all, Mark. This is a giant company. This is a huge company, and when you look at the amounts of dollars that some of the different businesses contribute, you begin to also realize that they have lots and lots of different businesses contributing significant amounts of money to the whole pot of pie. It's not just one business controlling a huge percentage of what Johnson & Johnson does. We do have to mention the fact, I think, that Johnson & Johnson has been talking about splitting itself apart the way Abbott Labs did a few years ago, and keeping the drugs and those types of products in one part, and all the rest of Johnson & Johnson, the Band-Aids, et cetera, in the other part of the company. So that'll be an interesting discussion. They're talking about a 3-year or longer runway to make that happen. So it'll be interesting to listen to what what is being said during the next two or 3 years.
Yeah, I think the investment banks have too much time on their hands. They've got to find something to do. So, yeah, that would be basically, if they go with the two-way split, that would be about a 50-50 split, because it's 50% pharmaceutical, 30% devices, and I believe 20% consumer goods. So you would be looking at possibly splitting into 2 or maybe 3 pieces like that. The combination of those 3 pieces right now accounts for $91 billion in sales. That's trailing 12 months. And again, the key indicator here is to observe the trend and observe that we are talking about a company with a slope or a growth rate of approximately 5%. So it's not unreasonable to expect in December 2026, 5 years from now, a number of somewhere around 116 billion for the business combination. So that's kind of our first milestone as we think about the company. You want to understand what is causing this company to grow. They have a couple drugs coming off patent, which would threaten a few $1 billion of that 90. At the same time, they have, I want to say, at least a dozen cancer-related promising stuff in the pipeline. So will the two offset? Perhaps. Johnson & Johnson believes that it'll more than offset the challenges with patent expirations. All right, so moving on to our second milestone. Basically, we just want to understand at the bottom line, what are the projected net margins in order to come up with an earnings per share, our second milestone stop. And you can see this is a company, just as Ken was talking about Sherwin-Williams a few minutes ago, this is a company that has been willing to shed less profitable divisions and basically acquire or expand out more profitable divisions. And that's what actually you see actually happening in the middle of the chart here. A little bit of portfolio management, and the net result being higher or better profitability on the right-hand side of the chart. Certainly defensible in an investment club debate to call the net margin anything between 25 and perhaps as high as 30. Value Line has chosen 29.3% for their projected net margin. So 5 years out, we're basically talking about $13.50 for earnings per share. Any comments or questions about that, Ken?
No, but again, it's a great point, Mark, and it should be emphasized that there's a lot of defensible numbers, and you have to make a choice when you're doing an analysis. Some of you might decide 28's a better number or 27's a better number, and of course that would then drop the earnings per share down a little bit. But there's not a single good answer. There's lots of good answers, and they're all going to lead you in the same general ballpark when you're all finished.
Okay, so now kind of cranking down the estimate, the third thing that you need in the preferred procedure, the way that we do, it's a simplified preferred procedure, granted, is a PE ratio. And so you've got a longer term history there, an opinion from Value Line that the projected PE ratio could be 18, 3 to 5 years out. I look at that diagram and say, yeah, that's certainly also defensible. And, something in the 15 to 20 range makes sense. And if you do choose 18 and you go with that assumption from before, adding in the projected dividend, which checks in at 2.5%, again, that's just a number coming from the analysts covering the company that expect, in this case, Value Line, 2.5% for the yield. You end up with a projected annual return, again, much like a Section 5 result on a stock selection guide of 10.2%. So that's our first observation of a return forecast. Call it approximately 10% for a company like Johnson & Johnson. Pretty good number. Pretty good number for a mature, stalwart company in a portfolio. And I should disclose I own some shares of this. You probably do too, Ken.
As do I. Uh-huh.
All right, so there's our 10% number. Again, just working through a sales growth forecast of approximately 5%. Something in the mid-20s, approaching the high 20s for a projected net margin, and a PE in the upper teens. All fairly viable, feasible numbers, a projected return of about 10%. All right, so let's talk about how we would actually use the projected return on value to give a bit of an audit to the situation. Same thing, we want to be focused in on the profitability only as was done back in that stock selection guide from 1941, back on that first page. We want to talk about profitability outside of accounting or tax-related noise, if you want to think of it that way. So we're basically just going up the food chain a little bit, talking about operating margin instead of net margin, or it's a close cousin to pre-tax income. So in this case, we take a look at Value Line, and they're talking about a 44% operating margin. You see the same type of picture, it's just a little bit higher up. And the reason it's higher up is it's before taxes, interest and taxes. And in this case, we're actually taking out or putting back in, if you want to think of it that way, the depreciation and the amortization. So the non-cash expenses have been completely added back in here. And we're really looking at the business operations, the profitability of that. And again, same type of picture takes shape here. Anything in the mid-40s probably makes a whole lot of sense. So we're talking about a projected operating income just north of $50 billion. Okay. So here's the final step in the puzzle, and it has to do with bringing the enterprise value to the calculation. And with enterprise value, we have to think about the total liabilities, debt and current liabilities, and the amount of cash that they have in their wallet. And this is just simply a quick lookup, whether it's on Morningstar or a couple other different sources. They have approximately 109 billion in total liabilities, and they have 31 billion in their checkbook. And you actually crank through the calculations using this formula: projected operating income divided by the enterprise value. And again, the enterprise value is basically the market cap, which is the stock price times outstanding shares, plus their total liabilities, this 108,960 number to the right, minus the cash that's in their wallet. And you come up with a number of 10.2%. So this one actually does check up 1-to-1. And what we're looking for here would be obviously a difference. If we saw a difference, we would wonder perhaps do a little bit of head scratching on the PE ratio. But I think it's kind of cool that this ended up here. And Ken said I shouldn't swear that I didn't go looking for a company where this was the case, but I'm telling the audience the God honest truth. I just grabbed one, Johnson & Johnson, and it actually ended up this way without being engineered. So I think for companies like Johnson & Johnson, I don't think this is going to be terribly unusual to find the two aligning with each other this closely.
Yeah, I made the statement before we started today that I would expect a really stellar blue chip company, any one of them that you could think of, I would expect their proved value and their par values to sit very close together when you did both calculations. I think the value of prove comes when we start to look at companies that aren't as widely studied and as widely understood as the blue chip segment of the market is. And when we start looking at companies where our sources, our Value Line source, our Morningstar source, have sometimes as much trouble coming up with estimates as we do. I mean, I don't think we should tell ourselves that we're the only part of the investing population that has trouble making estimates. I think analysts, when you sit down and talk to them over a couple of beverages, I think they're also willing to admit that there are lots and lots of companies where their models are as chancy as our models are. It's very difficult to take emerging companies, to take very small companies and make predictions that are going to be uniformly successful year in, year out. Hence the rule of 5, and hence the value of this new metric, the value of prove, which is pointing out that you might have some real issues when those two numbers, par and prove, deviate significantly from each other.
Yeah, and I think, as somebody pointed out to me just the other day, just reinforcing, for an early stage company, you also have a whole bunch of accounting stuff going on, captured losses and other things which disturb that bottom line. And this is going to be a lot less vulnerable to that and a lot more telling in an early stage company. So again, that's one of the reasons that we do this. Here's a look at Johnson & Johnson just with the whole picture in mind, and pretty compelling overall. Pretty compelling, but fairly valued. Here, here's a case where the Morningstar says, well, they're fairly valued, which would suggest, something in that 8 to 10% return arena. All right. So we'll cover more stuff like this in detail. We'll dig into a few more companies as we go. Did want to commit to putting together a Christmas countdown for this year, and we'll go back and take a look at the one from 5 years ago and have some fun, see how well that did. And over the next few days, as we celebrate the holidays, we'll come up with some new selections. So be forewarned, we'll probably have a couple or a few to talk about a week from today. And we still have a bucket. I just noticed that bucket list Alaska cruise on there, Ken. We switched it to a northeastern cruise at some point. That's still on the bucket list.
Gotta be able to get everybody on a ship to start with. That's
at some point we should be able to do that. By the way, I accomplished that bucket list. I went to Alaska after that with a bunch of people from Puget, Seattle, the Seattle area, and from around the country. Well, here's a reminder that we archive all of our bull sessions on YouTube. You can just go to YouTube and search for Manifest Investing. You will find this page. If you can't find it, let me know. But we also archive all of our expected returns monthly summaries, our roundtables, which are our monthly webcasts, and every once in a while we will have a special program like this fairly special program from fairly recently where we had a 4-session conference. We've had 4 of those, and they were a lot of fun. Some good information in those. The 20 questions with Cy was so much fun. Right there. Would encourage you to take a look at that. Quick reminder that our December roundtable will actually take place in January, just simply to avoid that week between Christmas and New Year's. Give us a little more time to do our homework, better shopping. Closer to the Epiphany, maybe we'll make better selections around the Epiphany. And I will leave you with a few images. The image at the top is my town. I believe, Ken, we actually walked around down there a few years ago. I don't know if that happens to be when I took this picture. But
well, Rochester is noted for their lights. It's one beautiful display. If you're anywhere in southeastern Michigan at Christmas time, you gotta take a few minutes and drive through Rochester itself. Great set of lights and lots of things to do in that little town.
Yeah, it is beautiful. And then the picture on the lower left, that's actually from when I went and kidnapped some family members using an RV. That's actually a year ago, almost to the day. And I submitted this to my wife to go out as our family Christmas card, and she vetoed it for some reason. But
the hat, probably, Mark. It was probably the hat.
Could be the hat. Might have been her robe too that was a problem. But anyhow, Merry Christmas to everybody. And then in honor of Epiphany and a fresh pack of Camels, we're ready to roll into the next year. Looking forward to it. But we will have a session next week, and I would like to dedicate that largely to Q&A and covering some of these topics. So bring out your best questions, guys. And with that, Ken, I think we can shut down and see if there's any questions. But
we're pretty well caught up on the question box today, Mark, so we can say goodbye and really mean it this time, okay?
All right. Merry Christmas, and just try to get that image out of your head, everybody.
Merry Christmas, everybody.
Take care.